I'm Connor McKenna, and welcome to the latest edition of Luma's Market Report, where every quarter we get you up to speed on the latest activity in ad tech, MarTech, and digital content. As always, you can find the full report on our website at lumapartners.com. In addition, this quarter, we are launching two new indices, Luma.A and Luma.M, to track the public market activity in ad tech and MarTech. More on that later. Well, the momentum continues with another very strong quarter of exit activity across ad tech, MarTech, and digital content. Even after breaking records in Q4 and Q1, we've done it again with all three sectors up again quarter over quarter. Importantly, this momentum is carried across both private and public markets with significant M&A, private financing, IPO, and de-SPAC transactions across all sectors. Let's break it down by sector. After a slow start to the quarter and some volatility in the public markets, ad tech ended on a high note with quarter of the deals announcing in just the last 2 weeks, including 2 exits for over $1 billion. With these exits, there were 4 new ad tech exits over $1 billion in Q2, bringing the year-to-date total up to 12. As a reminder, there had been only 3 ad tech exits over $1 billion in the 5 years leading up to 2021. So it's safe to say ad tech is hot. We chalk it up to 3 key elements: increased growth prospects, a reassessment of the business model, and an abundance of mature companies waiting for their moment. So we've discussed the increased growth prospects in the past, as ad tech has been one of the main beneficiaries of the pandemic inflections around streaming, gaming, and e-commerce. These inflections have driven both near-term and long-term growth prospects and helped drive the public market appreciation we've seen over the last year. It's also driven many companies to accelerate their M&A strategies and get ahead of the curve. While growth was a key catalyst for the spike in valuations, it's the reassessment of the business model that has allowed valuations to maintain and helped attract more businesses to the public markets. Historically speaking, ad tech has been valued somewhere between media and software, as the usage-based business model hasn't been seen as attractive as the annual recurring revenue and locked-in contracts of SaaS. While usage-based revenue allowed for quick growth, they weren't perceived as having the same predictability or operating leverage as pure SaaS businesses. That perception has begun to change. In a great article, SaaStr founder Jason Lemkin outlines how the definition of ARR is shifting from a strict requirement of annual locked-in contracts to a focus on net revenue retention of greater than 100%. Since that is the true measure of whether revenue is actually recurring. He highlights companies such as Snowflake, which has been skyrocketing in valuation despite being decidedly not SaaS. While they don't have locked-in contracts, they do have a staggering 162% net retention. Like Snowflake, most ad tech companies do not have locked-in contracts, but they do have reoccurring revenue, and many operate with net revenue retention above 100%. This, combined with the operating leverage coming from automation and programmatic channels, has allowed companies like The Trade Desk to operate at plus 30% growth and plus 30% EBITDA margins, and be valued much closer to software than media. It's this reassessment of the business model that is so important to the sustainability of the ad tech market, and the reason it should continue to be valued like software. It's also the reason we've seen private equity increasingly focus on this sector, as evidenced by Blackstone's recent $1.5 billion investment in Simplify. The final leg of the stool is an abundance of mature companies waiting for their moment. Given the historical perception around ad tech, many companies focused on executing their business and building out new capabilities rather than focusing on the public markets. Now that the public markets have caught up with the opportunity that they've always seen, these companies are taking advantage of this time and coming out to the market via IPOs and de-SPACs. We expect to see continued activity here as there's more mature companies that are still on the sidelines. We also expect this to be a huge boon for M&A activity in ad tech as these newly minted public companies continue to look for growth capabilities and now have to vie more and more with private equity. MarTech continues to be a pillar of stability with ever-increasing deal activity, strong public markets, and robust private financings. For the third quarter in a row, we've seen 9 scaled transactions across the MarTech sector, driven by a combination of private equity-backed businesses and strategic acquirers. Of note this quarter, there was significant activity around customer messaging platforms with 3 deals valued over $600 million. These included Cinch's $1.3 billion acquisition of Message Media, Twilio's $850 million acquisition of ZipWhip, and MessageBird's $600 million acquisition of SparkPost. Customer messaging has become increasingly important as businesses need to interact with customers on more and more digital channels. Now we're seeing a battle begin to form as these multi-billion-dollar platforms go head-to-head to become the communications platform of choice. In the public markets, MarTech companies bounced back despite continued inflation fears that began in Q1. This positive momentum was seen across the sector, with over 75% of MarTech companies outperforming the S&P 500 in Q2. This included some stalwarts such as Shopify, as well as strong performance from new entrants such as SEMrush, Sprinklr, and Squarespace, all of which IPO'd this year. Digital content had another strong quarter with both overall deal activity and scale deal activity increasing from Q1. This quarter was marked by 3 key deal trends. First, the ongoing activity in mobile apps and gaming. This subsector continues to be white hot following the pandemic inflection in gaming usage. Activity is coming from both mobile-first companies such as AppLovin, as well as console gaming companies like EA, moving aggressively into mobile with the $1.4 billion acquisition of Playdemic. Second was significant exits in digital media properties. Specifically, Apollo agreed to purchase media assets from Verizon, including the likes of Yahoo and AOL, for $5 billion. And BuzzFeed agreed to go public via a de-SPAC, which included the acquisition of Complex Media. Lastly, the quarter was highlighted by 2 mega deals focused on CTV content. These included Amazon's acquisition of MGM Studios and the merger of Warner Media with Discovery. We expect continued activity and consolidation as winners and losers begin to emerge in the streaming ecosystem. Finally, we're thrilled to announce the launch of 2 new indices tracking the public ad tech and MarTech markets. Now that there are dozens of public ad tech companies and public MarTech companies, we thought it was high time that there were specific indices available to track these sectors. Since we couldn't find any, we decided to build it ourselves. And these indices will now be available to download at any time on our website at lumapartners.com. That's it for us today. It continues to be a wild ride in this very exciting sector. Please remember to download the full report by going to lumapartners.com and subscribing so you can stay on top of all of Luma's content. Thank you for joining me. I'm Connor McKenna, signing off.